Hello, crypto enthusiasts and beginners. You're welcome to another edition of Victor Isibo Reviews. You're welcome to my Blackboard. All right. Now, in this video, I'm going to show you a way for you to make times 10, times 20, times 50, times 100 of your capital instantly, even before you start trading. Oh yes, you're gonna get it instantly even before you start trading. Okay, I know you're excited, but you're gonna get that information at the end of the video. Yes, I know a lot of you guys, you are not patient enough to attend the tutorial till the end. I know this is not a physical classroom where I can actually carry a cane and flog somebody's bum, but I'm gonna put an incentive at the end to ensure that you stick around till the end of the video so that you can get that incentive. So that information on how you can get up to even times 100 of your capital before you start trading, you're going to be getting that information in this video. But let us start the tutorial because we have a lot of things to cover in this video. In this video, I'm going to be telling you very important things that you need to factor in when you start trading cryptos. Even the best traders in the world, okay, they become the best in the world because they have taken care of the basic things. Okay, if the foundation is shaky, the building cannot stand well. Okay, if you start a building on a shaky foundation, it's useless. All right, so these are the foundations of crypto trading, and I will bring complex terminologies in crypto and break them down for a 5-year-old to understand. Okay, the first one I want to talk about, let me just put a brief on my board. The concepts that we're going to talk about, take profit today. Okay, take profit, which we'll call TP. Okay, we're going to talk about stop loss, okay, which experts call SL. Today we're going to explain in further details, even though we talked about it in the last video, short and long. Okay, the meaning of short and long, okay, when it comes to futures trading. Then finally, we're going to talk more about characteristics of futures trading as compared to spot trading. Then finally, how to get times 100 of your capital even before you start trading. All right, so that's what we're going to do today. I hope you will enjoy the class. There's big news at the end of the video. Make sure you stick around. Now, let us first of all talk about take profit and then stop loss. All right, take profit and then stop loss. Okay, now when you're trading, all right, you have a busy life schedule, you have business that you're doing, you have a lot of things to attend to. All right, so when you're setting a trade on the exchange, all right, you are able to give instruction to the exchange on how your trade is meant to be managed. Now, as the name implies, take profit talks about you setting a certain parameter, certain conditions, that if that condition is reached, that trade is supposed to be closed for you. The profit therein is supposed to be taken and closed for you. Okay, while on the other side, stop loss means that you are already predetermining the loss you want to take on a particular trade. Okay, you are instructing the exchange to close that position when your losses get to a certain extent. All right, now let us go into further details. I think we're going to cover short and long in the explanation of take profit and stop loss as well. So we're going to be killing two birds with one stone. Okay. Now, in futures trading, okay, in futures trading, you can make money whether the market is going up or coming down. That is futures trading for you. In futures trading, you make money whether the market is going up or coming down. Okay? Based on your prediction. Okay? Like we said in the earlier video, it is more or less as if you're gambling where you're trading futures. Okay? Because all you are doing is you are predicting the direction of the market. All right? Without actually buying the assets that you are trading. Okay, so you make money whether the market is going up or coming down. So let us take, for instance, we want to trade Ethereum, ETH. Let's say we want to trade Ethereum, ETH. And now let's assume that the current price of Ethereum in the market is $5, for instance. Okay, $5. Now, we want to trade Ethereum. Now, if we say the price of Ethereum is going to come down, that is our prediction. The price of Ethereum is going to come down. That means that we are predicting a short. We are predicting a short. That the price is going to do what? Come down. We are predicting a short. If we say the price of Ethereum is going to go up, like so, we are predicting a long. Some people call the short, they call it a sell. They call it a sell, while they call the long a buy. Okay, they call the long a buy, and they call the short a sell. All right, and when you set up a trade in futures on the short, you see it appears as a red. You know, you're predicting that it will go down. Okay, while the long is represented in color green. Okay, now with that being said, let us now dive deep into the characteristic of each one. Okay, futures trading, you make money whether the market is going up or down based on your prediction, while in spot trading you only make money when the market is going up. Okay, now for Ethereum, real quick, if we're predicting a short, and Ethereum, as at the time we're trading Ethereum, the price of each token is $5. If the price of Ethereum reduces after we start this trade on a short, it reduces to $4. We are making money. We are making money. The price reducing to $4, our short trade will now be in profit. Okay? Now, if the price of Ethereum, after we set a short trade, were to increase to $6, we are making losses. You understand? If the price, when you say short, you're saying that the price will come down. If the price comes down to $4, you are happy. You are making money. If it comes down to $3, more money for you. You have made $2 profit. If it comes down to $2, more money for you. But if the price begins to go up, you are making losses. While this is the vice versa. On the other side, when you predict a long, you are anticipating an increase in the $5 price of Ethereum. So if the price of Ethereum climbs to $6, congratulations, you're making money. To $7, you're making money. But if it goes down to say 4 or 3, then you're losing money. So in futures trading, okay, in futures trading, let us just break it down finally. In futures trading, the happiness of one person is the sadness of the other person. Okay? While some people are happy in futures, While some people are happy, some other persons are crying. Okay, because it's all about predictions. It is all about what you said will happen. And everybody cannot say the same thing. Your analysis shows you one thing, my analysis shows you another thing. So when you hear about liquidation, some people have their accounts wiped. Okay, some people are becoming millionaires. All right, when you hear about liquidations, for instance, let's continue to use Ethereum. Ethereum at $5. If the price of Ethereum was to fall to 20 cents, 0.20 to 20 cents, all the way from $5, people that are on long trades for Ethereum, who are predicting that the price will go up, all of them will be what? Crying. All of them will be crying. Why? Because they predicted that this $5 would go up. And there will be massive liquidations for those that are trading Ethereum on long. Massive account wipeout. You see people wake up, they had a $1,000 trade going on for Ethereum, they will wake up to see nothing. Total wipeout. At a later time in this video, we will talk about liquidations as well. Okay? We'll mention liquidation and explain it in full details. Now, when those people who were trading long on Ethereum are crying when Ethereum price dropped to 20 cents, as they are crying, what is happening to those that are trading Ethereum on short? Short means that they are predicting that the price of Ethereum will do what? Come down. What would they be? They would be happy. Okay? They will be happy. All of them will be happy and they will be celebrating because their prediction worked and it worked very well. So somebody's liquidation in futures is another person's account appreciation. All right? The only people who win together and lose together at the same time are people that are trading spot. People that are trading spot trading. In spot trading, everybody wins together and loses together. Because in spot trading, you only make money when the market is going up. So if the market is going up in Aba, it is also going up in Owerri. It is also going up in Benin. It is also going up in Kaduna. So everybody is happy together. And that is why in my former video, I talked about the seasons of trading, the bull season, the bear season, and I also talk about the sideways market. But let us base it down to two seasons in trading. You have the bull and you have the bear. Okay? The bull season is when the market is going up. The prices of cryptos are appreciating, going up. The bear is when they are coming down. You see people who are into spot trading, they love the bull season a lot because that is when they make the bulk of the money they make. And they hate the bear season a lot because a lot of spot traders, many of them go and start learning mechanic, welder work during the bear season because nothing is moving. Okay? Spot trading is unidirectional, one direction. Up only, you make money. Down, you don't make money. While in futures trading is not a seasonal business. Okay, you make money whether the market is going up or coming down. Okay, so you see that the general mode of trading, okay, for those that are trading futures, the general mode of trading during the bull season, if they were to pick a direction, is always long. Okay, so if you want to trade futures now, your best bet is to trade long because we are in the bull season when everything is doing what is going up. Now, there are things that are called retracements. Retracement means that even though this season market is meant to be going up, but every now and then markets can come down. Every now and then market can come down, and those that are on short, they will still take some profits. All right, while market continues to go up. Remember, in the last video, all my tutorials are important in your journey for crypto. We cannot put all in one video. go and watch my last video. They will be in the end card of this video, and some of them will show up in the cards above this video. Okay, I drew a chart in the last video for you to understand how the market goes. I told you the crypto market is very volatile. Okay, so this particular trend of a chart, you will see that the overall mood of this, the overall direction of this particular chart is what, according to my arrow, it is going up. Okay, but you will see there are ups and there are downs. Ups, downs, ups, downs. Okay, so it goes up, it comes down, but you know, when you look at the overall direction, it is going up. Okay, so this is a typical volatility in action, where everybody gets to take some money from the market. Even though the market is going in one direction, the other directions are being favored temporarily before the main direction then continues to hold sway. Okay, so now we have explained short and we have explained long. So whenever you hear somebody says, a professional says, because they like to confuse newbies like you, say, oh, I am shorting BTC. If somebody says I'm shorting BTC, it means that the person is predicting that the price of Bitcoin is going to go down. That is why they say they are shorting BTC. Okay, they are predicting that the price of Bitcoin is going to go down. Okay, so if such a person now comes back to say, I'm longing ETH, that person is predicting that the price of Ethereum is going to go where? Up. All right. So for the person shorting BTC, if the price of BTC goes up, that person is losing money. Okay. For the person longing ETH, if the price of ETH goes down, they are losing money. The person shorting BTC, if the price of Bitcoin comes down, he is happy. So in the entire futures trading community, everybody cannot be happy at the same time because everybody made different predictions. Okay. It's like going to a Bet Naija shop. All right. You will see some people crying that Manchester United lost, while some people are happy that Manchester United lost. It is because of the different predictions that they made. In a Bet Naija shop, you will see different people with different moods. Some are happy, some are not happy. Some that predicted just goal. You see somebody, a Chelsea fan, Chelsea has won a match. 5-0, Chelsea has won. The guy is a Chelsea fan, yet he is crying. Maybe his own prediction is that Palmer is going to score, and Palmer did not score any of these 5. His ticket has cut. That is why he's crying. So when you see anybody crying, leave them alone. They are the ones that know exactly what they predicted, and probably they have lost money. So very quickly, we're going to talk about 2 very important concepts in trading, which is take profit, which they call TP, and stop loss, which is called SL. Now, when you're trading, it is very important you use both of them, okay, to keep your account safe. As a matter of fact, any professional trader that has common sense, you can decide to forgo take profit. You can decide to forgo take profit. But you see this one, stop loss, it is very, very, very important. Now, let me break it down. I'm going to be addressing stop loss as SL so that I'll limit what I'm writing, and take profit as TP henceforth. All right. SL, stop loss, is very important. Okay, very important. Now, let us use Ethereum at $5 that we used earlier as example. Okay, Ethereum ETH is $5. So let us assume I want to short Ethereum. That is, predict that the price will go down. Okay, I'm predicting that the price will go down. So for this trade to go against me, for me to lose money, the price of Ethereum will do what? Must do what? It must go against me by going up. So I must put a stop loss. I must tell the exchange, I am predicting that the price of Ethereum will go down from that $5 to maybe the $4 or $3 or $2 region. However, because I am not God, however, if the price of Ethereum were to move against me and go up to $8, please close down this trade and let me take the loss. You are instructing the exchange, do not wipe out my account, or I don't have much money in the account. If this trade continues to move against me and the price of Ethereum gets to $8, please close the trade. Let me save my account. I beg. It was my elder brother that gave me the money that I'm using to trade this particular trade. Okay, close my account jejely and save my money. That is what you have said. Okay, now let us look at the case of if we were trading a long on Ethereum. Let's say we are trading a long on Ethereum. Talk about the stop loss that we can use. Now let's say we are longing Ethereum. Long. So what we're predicting is that the price of Ethereum will do what? Go up. But if the price of Ethereum were to come down, we will be losing. So our stop loss here, we can put our stop loss at what? $2. SL, stop loss. We are telling the exchange, Biko, we say the price of Ethereum will go up to the $6, $7 or $8 region. I beg, if it is moving against me and going down to $4 to $3, as soon as it gets to $2, do not wipe out my account, close the trade, let me take the loss. They say he who fights and runs away lives to fight another day. That is what stop loss is all about. Okay, Yoruba people say moja mosa la fi mo ye okunrin la fi mo ye akinkanju. He who knows how to fight and run away will be alive to fight another day. That is stop loss. Stop loss is meant to protect your liquidity, protect your capital against total account wipeout or liquidation. Okay, so the same concept. So stop loss is the opposite of take profit. Okay, take profit is saying because let us talk about take profit now. I'm going to be writing it as a TP. Okay, TP, take profit. TP. Take profit says, for instance, if we're trading short on Ethereum that is selling at $5 per one, we are predicting that the market will go down. Okay, so take profit is saying if the price of Ethereum is going down to $4 to $3, once it gets to $2, take that profit for me and close the trade. Take that profit for me and close the trade. While if we are doing TP, take profit on a long trade. Let's say we are longing Ethereum, predicting that the price will go up. We can say once the price of Ethereum gets to, from that $5 gets to $6, $7, once it gets to $8, take the profit for me. Take the profit for me and pull me out of the market. Okay, once it gets to $8, take the profit for me and pull me out of the market. So take profit on a short to $2, take profit on a long to $8 for a $5 Ethereum trade. Do you know why a take profit is important? Okay, let's say you're trading. All right. And as soon as you started trading, before you know, your friends just came visiting. Oh, Victor, I see Bafana, how you doing? Hey, they start talking. They start talking. And I am longing Ethereum, predicting that the price will do what? Go up. So as my friends came, This is my trade chart. Okay, the bottom number is $5. As my friends came and they were talking, price moved towards $6. Okay, the next thing, they are still around, price moved to $7. I'm already in profit, but I'm talking to them, discussing with them. I did not set my take profit to. Price continued, moved to $8. Then the next thing, price dropped to $4 as I'm talking to them. By the time I finish talking to them and I check my trade and see it's at $4, I am not happy because I was busy and I missed the pump. But if I had set my take profit at $8, this trade would have been closed for me at this point, even when I'm not there, because it's an instruction. It is an instruction. You will see it as an open order on the exchange. Open order. They will put it there. Open order. This guy has made an order that this thing should happen, and you will see it there. Okay, so a live setup of take profit and stop loss will flash on your screen now, so that you have a better understanding of how to set it in your exchange. Okay, you're going to see it as a pair on a trade, TPSL. Okay, you're going to see it and you'll be able to set it for yourself on every trade that you are trading. All right, so see how it is done on your screen. Okay guys, so when it comes to take profit and stop loss, this is a typical ongoing trade, okay, on BTC. All right, and you can see the leverage is 50x at the top. All right, and at the middle bottom you will see TPSL, that is take profit stop loss. Let's click on it. Brings a pop-up and you see all. Let's select all positions. All right, now the take profit, when you look at the entry price, look at the current market price. The current market price is 99,826. Okay, that is the current market price, and this is a long trade. We are predicting that market will go up. All right, that means that if market is coming down, it is a problem for us. We don't want to set take profit, let the trade just continue like that. But if we want to set take profit will be a number that is higher than the mark price. A number that is currently higher than the mark price, because you're saying we are predicting that the market will go up. So we're saying if the market goes up to a certain extent, take profit for us. So we can put our take profit at 105,000. Okay, which is higher than the current mark price of 99,816. You will see that they have written at the bottom that will mean that we are taking a profit of what? 28 USDT. All right, so stop loss is going to be a number that is lower than the current mark price. That if the market is now going against us, going lower, because we predicted long that the market will go up, if the market decides to go lower than the current mark price, protect our capital by closing this trade and taking us out of the market. So our stop loss amount must be lower than the current mark price of 99,837. So we can put our stop loss at, say, 98,000. Okay, 98,000. You have seen at the bottom, it has told us the amount of money we would lose if our stop loss is at 98,000. It says minus 9.66 USDT is what we will lose. So stop loss is important to protect your account. Now, if this trade was a short trade, we predicting that the market will go down below that 99,000, our take profit will be lower will be lower than the current mark price, because mark price is 99,000 plus. We are predicting that the market will go lower. So our take profit will be around, say, maybe 96,000, okay, or 95,000. Why our stop loss will be higher than the current mark price, because we are predicting that the market will go down. But if the market is going higher, we must put our stop loss at a number that is higher than the current mark price. I hope this is abundantly clear. Now, let us now talk about what you have been waiting for. How to make times 100 or times 50 or times 20 times 10 of your money even before you start trading. Okay, so the topic of this one is going to be leverage. Okay, leverage. Now, this free money is only given to you when you're trading futures. Okay, now futures trading is more profitable than spot trading because of this concept called leverage. Leverage, in a layman's term, is the exchange borrowing you money to trade. They will borrow you. You have available different amounts that you can borrow, and they will give it to you instantly for free. So let's say your capital, okay, is $100. The exchanges can offer you 10 times your capital as loan, 20 times, 50 times, even 100 times your capital as loan to trade with. When you make profit with that loan, you keep the profit to yourself. You keep the profit to yourself. Okay? So let us now wipe out the 10x and 20x. Let us use 50 times as example. Okay? So when you take this your $100 capital into the market and you are using a 50x leverage, your $100 automatically is represented as $5,000. So automatically now you have $100, but you are trading with $5,000 capital. I'm telling you, automatically you are trading with what? $5,000. If it is 100x, automatically you are trading with $10,000. But let us use $50 as example for this video. So on your $100 capital now, in a trade, that your $100, that your $100 using 50x leverage. If you make only $1, if you make just $1 profit in the market, you'll be getting what? $50. based on the leverage you are using. Your $1 profit on your $100, it is $50 that the exchange will give to you. Why? Because of this guy, this 50x leverage you are using. Every $1 you make in the market, it is $50 that you will get in return. So 1% profit that you will make is what? $50. 1% profit. You know, 1% of 100 is 1. You will get $50 for 1% profit that you make. Every 1% profit that you make on a $100 capital with a 50x leverage, you will get $50. Are you guys excited? I know you're excited. 1% profit, 1% movement in the direction of your prediction, whether short or long, just 1% movement. 1% movement, you are getting $50 as profit. Okay, so let us state it categorically. $100 capital on a 50x leverage. 1% profit amounts to what? $50. I have bad news. Now, this is the bad part. Futures trading is a double-edged sword. Leveraged futures trading is a double-edged sword. My brothers and sisters, we have talked about 1% profit amounting to $50. Let's talk about 1% loss. It amounts to what too? It also amounts to $50. So for your capital of $100 to wipe out, you need how much? Just 2% loss. And your capital has finished. Just 2% movement against your prediction, you will get a margin call notification. Your exchange will send you a message. They will say, Oga, please add more money to your account. Add more money to your account. If you don't add more money to your account, you cannot trade another position again. Your money is about to be exhausted. Yes. So what leverage does is it magnifies not only your profit, it also does what? It magnifies your loss. Okay, let me repeat that. Leverage magnifies losses and profits. Okay, the bigger the leverage you are using, the quicker it is for you to be liquidated. And the bigger the amount of money you make if market is moving in your direction. So it's a double-edged sword. All right, that's why you see some exchanges will not allow a new account that you open to trade more than 10x, because they will assume that you are new to trading. This guy just opened this Bybit, this Binance, and he wants to trade 10x. No, we will not agree. He wants to trade 20x. No, we will not agree. Okay, because it carries with it significant risk. All right, just 2% loss in the market. Your $100 capital trading at 50x leverage is gone. It's gone. If you're using 100x, just 1% movement against you, your entire capital is wiped out. But remember, when you make 1% profit, it's $50. For 50x, $100, when you make 2% or more, you have doubled your capital. All right? So this is why futures trading is riskier than spot trading. In spot trading, there's nothing like liquidation. Spot trading is slow and steady. Slow and steady. Spot trading is a seasonal thing. Let's just talk about spot trading real quick to end the class today. Okay, spot trading, spot trading suits best people who have good capital. Okay, good capital, so that no matter the little amount they make, because of the little capital, the profit is significant. Okay, spot trading is slow and steady. Okay, spot trading is kind of seasonal. All right, it does best in the bull run. Okay, it is also limited, based on you only make money when market does what? Goes up. That's when you make money. You only make money when the market goes up. All right. And also, spot trading, it leaves you at the mercy of the market. The market determines your success in spot trading. But in futures, you don't allow the market to determine your profit, your profit or your success. Anywhere the market is going, you can make money. Whether the market is going up, you can long it and make money. Whether the market is going down, you can short it and make money. As a matter of fact, in futures trading, you can trade both directions at the same time. I mentioned it in the last video. You can trade both directions of the market at the same time. That's what they call hedging. Okay, that's what they call hedging or hedge mode. Okay, in futures, you have more options. In futures, you can be more versatile. Okay, you're not limited, you're not caged in one direction. Okay, you have more options for futures. All right. Okay, you can make money whether the market is going up or down for futures, while in sport you make money only when the market is going up. In futures there is a risk of liquidation. In sports it is NA, non-applicable. There's nothing like a liquidation in sports. Okay, in futures you get leverage. There's nothing like leverage in spot trading. All right. In futures you have more options. Okay, you have more options for trade. You find people, futures will test how good you are at trading because you're making predictions. Market going up, market coming down, you do your analysis, you're able to predict correctly. Okay, so futures is a better test of your trading skill than spot. I hope you enjoyed this video. Please make sure to join the WhatsApp groups and Telegram groups in the description of this video, where we share tips and tricks for how to grow in the crypto market. Also interact with the affiliate links in the description of this video. Thank you very much. My name remains Victor Isibo, and I hope you enjoyed the class. I will see you in the next one. Until then, it is bye bye.